Did you know that the commodities trading market in India dates all the way back to 320 BC? Chanakya's Arthashastra, which is a handbook for how to reign over a kingdom, with emphasis on political science, economic policy, and military strategy, talks about the pricing mechanism of standing crops and also mentions terminology like tezi, mandi, gully, fatak, etc. These are synonymous with present-day derivatives trading. Hello, my name is Madhubani Singh, and in this video I will be telling you about what derivatives are, what are they used for. I will also be going in detail about two derivative instruments, namely forwards and futures. I will also be talking about some key concepts like margins, square off, leverage, shorting, etc. that we must know about when we are dealing with futures contracts. So let's begin with what derivatives are. In simple words, derivative is something that derives its value from another source. For example, butter is a derivative of milk. The price of butter depends on the price of milk. In finance, derivative is something that derives its value from an underlying asset. The asset could be equity, bonds, commodity, currency, interest rates, or market indices. These derivatives can be traded on the exchange or over the counter. The first ever organized commodity trading in India took place in the year 1875 with the constitution of the Bombay Cotton Trade Association. However, over the next century, there were several prohibitions on derivative trading in India, and it was only till 2002 when SEBI, which is the Security and Exchange Board of India, officially permitted all the derivatives to start trading again. Derivatives are mainly used for speculation, hedging, and arbitrage. Speculation is a trading technique which is undertaken to profit from an expected price movement. What that means is that the trader guesses where the market or a particular stock is headed, either bullish or bearish. For those who don't know, bullish is when you expect the prices to rise, and bearish is when you expect the prices to go down. So the trader buys at a lower price only to sell it at a higher price later, or sells it at a higher price only to buy it back later when the prices decline. For a derivatives contract, the counterparties must have an opposing view of the market. When we discuss the derivative instruments in detail, you will get more clarity on this topic. For now, it's just important that you understand what speculation is. Hedging is a technique that is used to reduce the market risk in an existing portfolio. When a trader executes this technique, he or she basically takes an offset position so as to protect the existing market position. If a trader purchased an asset earlier but feels that the price is going to decline, he or she may sell the same in the derivatives market so that there is no loss incurred. We will discuss more about hedging in just a few minutes. Arbitrage is a technique that is guided by the desire to make profits from the discrepancy in the prices between the cash and the derivatives market. For example, a trader can buy securities in a cash market and then immediately sell it in the derivatives market where the price is higher, or vice versa. Before we move forward, it is important to know the difference between exchange trading and over-the-counter trading, as this forms the primary difference between the different derivative instruments. Those who know what these trading modes are can skip to this timestamp. For those who don't know, here's a quick reference. Securities are traded in two modes, exchange or over-the-counter. When trading through an exchange, an investor places the order in the order book of the exchange with details such as the price and quantity of the security and whether he or she wishes to buy or sell the same. Prices quoted by others can also be seen in the order book. Hence, there is transparency in the prices of securities. However, the counterparty is unknown. The exchange will match the requirements, prices first, with the counterparty. Now, order match is not guaranteed. However, once a match is found, order settlement is guaranteed. This is so because both the counterparties are required to maintain a margin with the clearing house, which is ultimately responsible for the settlement of the trade. The seller must keep the securities and the buyer will keep an equivalent cash margin as deposit. This reduces the risk of the trade failing. In case either of the counterparties is unable to fulfill their obligation, the clearing house will step in and settle the trade. This is a highly regulated market with very low default risk. In over-the-counter trading, an investor must first find a trader or a broker to deal with and inform them of the quantity of the security they wish to buy or sell along with the price. Now, since the counterparty here is known, prices may be negotiated upon. However, the investor does not know how much the seller paid for those securities, so there is no transparency in the price. Order settlement here is guaranteed. Even if one counterparty was unable to commit to the trade, there are several others in the market. However, order settlement is not guaranteed. This is because both the counterparties do not maintain a margin with the clearing house and there are no regulations to oblige. So either of the counterparties can default. Due to this, over-the-counter trading has a high default risk. In order to eliminate this risk, central counterparties are involved that ensure a fair settlement of the trade. Let's continue with our main topic. So the different derivative instruments are forwards, futures, options, and swaps. In this video, we will focus only on forwards and futures. So what is a forwards contract? A forwards contract is a customizable contract between two parties where one is the seller of an asset and the other is the buyer of that asset, where the price of the asset is agreed upon at the time of entering into the contract, but the asset is delivered at a later date. A forwards contract helps in discovering the price of the asset and in price risk management. Let's understand this with the help of an example. Let's say Richa and Company decides to import cotton from US. They placed an order for goods worth rupees 80,000 US in April and expect the delivery in July. Now, as per the terms of the trade, Richa and Company has to make the payment in July, but they feel that the price of dollar is going to rise in the coming future. So they enter into a forwards contract with their bank to buy the US dollars at the current price in 3 months. Now, after 3 months, in July, if the price of the US dollar goes up, Richa and Company profited from the contract. But if the price of the dollar went down, they will incur a loss, and that is part of the game. So this way, the market risk is managed by entering into a forwards contract, the price of which depends on the quantity and the price of the cotton that is being imported. Forwards contracts are traded over the counter and carry a substantial amount of counterparty default risk and regulatory risk, as there is no definitive regulatory body to ensure the compliance of the agreement. Now, this is where the futures contracts come in place and eliminate the risks involved. Futures are a standardized contract to buy or sell the underlying asset at a fixed price at a fixed future date. These are traded on the exchange and are highly regulated. The contract is standardized in the sense that the exchange fixes the expiry date of the contract and the lot size, which is the minimum fixed quantity of securities that must be traded. The futures contracts are issued by the stock exchange as a source of income for them. They charge a transaction fee, which is the revenue for the exchange. The counterparties are required to maintain a deposit with the exchange known as margin to cover the risks involved. So what happens in a futures contract is that at the time of initiating the contract or trade, the trader need not invest the entire contract amount. Only a margin amount is needed to trade in futures and uses its leverage to participate in large transactions. This is what makes trading in futures contracts very lucrative. Let's talk about some of the key features of futures contracts. The first one is that the value of these futures contracts depends on the value of the underlying asset. For example, Axis Bank futures contract depends on the Axis Bank stock price. Just as the stock price fluctuates, the contract price also fluctuates. These are standardized contracts. For example, like I had just mentioned, that the lot size is fixed by the exchange. So if it is fixed at 500 shares, this quantity cannot be changed. Futures contracts need not be held till the maturity. They can be traded before that as well. As long as there's a buyer or seller in the market for it, we can trade it before maturity anytime. These contracts are highly regulated. For example, in India, SEBI is the regulatory body overlooking the activities of the futures contracts and ensures that there are no defaults. And lastly, these contracts are time-bound. They are offered for trade in time frames of 1 month, 2 months, or 3 months. Now, when we deal with futures contracts as a trader or a back office analyst, there are several concepts that we must know about. Let's understand what these are. The first one is margin, also known as initial margin. This is a percentage of the total contract value that must be deposited with the exchange in order to enter into a futures contract. It comprises of a span margin, which stands for Standardized Portfolio Analysis of Risk margin, and an exposure margin. Now, span is used to calculate the risk of the contract. Since the exchange is responsible for the settlement of the contract, this margin acts like an assurance in case of any default. Exposure margin, on the other hand, is an additional margin over and above the mandatory span margin. Now you may ask, why do we need an additional margin? Well, to understand the reason behind this, let me explain to you another concept to understand this better. In futures trading, any profit or loss incurred due to the change in the prices of the underlying asset is calculated on a daily basis. This is known as marked to market, or MTM. Any profit or loss incurred is debited or credited to the trader's account at the end of the day. Now, if the trader has incurred loss that is over and above the span margin, the additional exposure margin is used to cover that loss. And if even that is not enough, the exchange may ask the trader to deposit an additional margin. This is known as margin call. I will explain all these concepts with an example in just a few minutes. For now, just try to understand the theoretical meaning of these terms. Let's talk about this very interesting concept that makes trading in futures contracts very lucrative. When you have to buy 100 stocks, you have to transfer the entire worth of the stocks to the seller. But in case of futures, you are only required to deposit a certain percentage of the total contract value, which is the margin. And basis this margin, you are able to trade for a much larger amount. This is known as leverage. The percentage of the margin depends on the volatility of the underlying asset, which is different from one company to the other, one sector to the other. The higher the risk, the higher the margins required and the lower the leverage. And the lower the risk involved, the lower the margin and a higher leverage can be enjoyed. Next, let me tell you about futures payoff. I'm sure by now you must have figured out that there is a difference between trading in the securities in the spot market versus trading in the futures market. If we were to do a comparative analysis of the initial investment and the return earned in the spot market versus the futures market, we would get the return on investment or ROI in both the cases. Now, basis this ROI, we can see how much money we can make or lose in the futures market. This amount is known as the futures payoff. The next concept that I'm going to tell you about is called square off. When we close a futures contract, either at the time of expiry or if the trader exchanges the contract with someone else during the term of the contract, the position is squared off. What this means is that if the trader initially bought the contract or was long on the trading position, in order to close the contract, he or she must sell the same asset in the same quantity. When we transfer the contract to someone else, it also means that the risk of the trade going in the opposite direction gets transferred. That is why it is known as risk transfer. After the position has been squared off, any profit or loss incurred is debited or credited and the margin is released by the exchange. Even if you understood some of it, it's okay. I will explain this more with an example in just a little bit. The next concept that I'm going to tell you about is called shorting. It is slightly technical, so pay attention here. So far, we talked about entering into a futures contract to buy the underlier since we expect the prices to increase in future. Now, what if the prices were to decline in the future? In such a scenario, we would first sell the underlier and square it off by buying the same underlier in the same quantity once the prices decline. Now, this might sound a little confusing, but hold on to the information. It will make a lot more sense when I explain it with the example. The last thing to know about futures contracts is the types of orders that can be placed. There are primarily two types of orders, overnight and intraday. Overnight is an order type wherein the contract is held overnight for a few days or even a few weeks. Since the duration of the contract is long, the exchange considers these to be risky. On the other hand, intraday is a type of order which is held for only a few hours or even a few minutes. These contracts must be squared off at the end of the trading day. Now, since these contracts are held for such a short duration, the exchange considers these to be less risky. Let's consider a hypothetical scenario. Trader Neha wants to buy HDFC Bank futures expiring in April 2023. The stock price of HDFC Bank, which is the underlier, is rupees 1,692 and April's future price is rupees 1,698. Now, the difference in the price of stock and the futures contract is because of the administration costs incurred in the execution of the contract. Trader Neha is bullish on the market trends and expects the stock price to go up in the near future. The lot size fixed by the exchange is 550. This means that the futures contract value is equal to rupees 9,33,900. And if she were to buy the 550 shares in the spot market, the total value would be rupees 9,30,600. Now the margin required is rupees 1,65,179, which includes the span margin of rupees 1,32,490 and the exposure margin of 32,689. As we can see that with a margin amount of rupees 1,65,179, Trader Neha is able to trade in stocks worth rupees 9,33,900. This is leverage. Now, these are all hypothetical figures for the purpose of explaining the concept, but reflect the effect like that in the real world. Let's suppose we are holding the contract for 5 days, that is from April 10th to April 14th. As we can see in the table, we have the date, the reference price for mark to market or MTM, which is the previous day's closing price, and the closing price for daily mark to market, profit or loss incurred in the trade. Now let's say that on April 11th, the price went down, and on April 13th, it declined so much that the entire span margin is consumed. At this point, the exchange will ask trader Neha to deposit some more margin amount. This is called a margin call. And to know the future's payoff, let's pay attention to this table. It gives a comparative analysis if these stocks were purchased in spot market versus the futures market. In duration of 5 days, Neha can earn a profit of rupees 1,815 in the futures market as opposed to rupees 1,650 in the spot market. The amount she can earn in futures market is the futures payoff. This helps to decide if it is actually worth the trade or not. Now, when after 5 days, Neha no longer expects the price to increase, she transfers the contract to another trader, Amit. It also means that she has squared off her position by selling the exact contract asset, that is the HDFC Bank shares, in the same quantity, that is the lot size and the number of lots purchased. Next, let's talk about shorting with the same example, except that now trader Neha is bearish on the market trends and feels that the stock price will decline in the coming future. In this case, she will first short or sell the futures contract and then buy it back in 5 days once the price has declined to square it off. When it comes to hedging, in general, it means to enclose something to protect it. Let's say Neha had previously purchased the HDFC Bank stocks in the spot market for a short-term trade. But now she feels that the stock price is going to decline and she might incur a loss. So in order to protect her investment or manage her risk of loss, she can short or sell the HDFC Bank stocks in the futures market first and then square it off by buying it back. Let's see the impact of the same on her profit and loss. Once again, these are hypothetical figures to explain the concept. As we can see in the table, regardless of where the price goes, Neha will end up making a profit of rupees 6. It is not a big amount, but a positive number is always better than a negative one. This way, her investment is secured. Now, this by no means is the complete list of the concepts and terminology in futures trading. There are several other concepts and strategies out there. But for the purpose of basic knowledge about futures trading, I chose to explain these.
I hope this video gave you plenty of information about derivatives, forwards, and futures. If I missed out on something, please do let me know. And do share your views in the comments. Thank you and have a great day.